For decades, the world's biggest banks secretly manipulated the price of money itself, the cost of your loan, your debt, and in many ways, your future. That number was called LIBOR, the London Interbank Offered Rate. At first glance, it sounded technical and distant, but in reality, it was the heartbeat of the global financial system, shaping trillions of dollars in contracts, loans, and investments. Every day, major banks like Barclays, J.P. Morgan, Deutsche Bank, UBS, and Citigroup were asked a simple question. If you had to borrow money from another big bank today, what interest rate would they charge you? Each bank submitted its answer. The highest and lowest were discarded, and the average of the rest became the official LIBOR of the day, the number that influenced nearly every interest rate on Earth. The system seemed elegant and efficient. But there was one critical flaw. Those numbers weren't based on actual transactions, only on estimates. It all relied on trust, the assumption that trillion-dollar institutions would tell the truth, and that misplaced trust opened the door to one of the biggest financial manipulations in history. LIBOR wasn't just for banks. It was the invisible benchmark behind almost everything. Mortgages, student loans, credit cards, corporate debt, and even government bonds. Economists called it the world's most important number. Yet this vital index was built not on real data, but on daily guesses from a handful of banks. For years, the system seemed to work, but within the financial world, a quiet realization spread. If even a tiny change in the rate could move trillions, then whoever influenced that number held immense power. And in finance, power is never left unused. The manipulation was surprisingly simple. Imagine 16 banks submit their rates. If a trader holds a position that profits when rates rise or fall, he could simply ask a colleague to nudge their submission slightly. A tiny adjustment, a fraction of a percent, could shift billions of dollars in an instant. This became routine. Traders coordinated through secret chat rooms nicknamed the cartel or the mafia, casually joking about fixing the fix. They exchanged favors, champagne, and tickets to Wimbledon, while quietly moving the price of global money. It wasn't a single rogue act. It was a culture of manipulation woven into daily operations. By the 2000s, the scheme had spread across continents. And when the 2008 financial crisis hit, the LIBOR, the supposed measure of trust between banks, became fiction. No one trusted anyone, but no one dared admit it. To appear strong, banks began reporting lower borrowing rates, pretending everything was fine. The interbank market had frozen, but the thermometer still read normal. As one economist later put it, LIBOR was like a thermometer showing 98 degrees while the patient was in cardiac arrest. Banks lied to save face, regulators looked the other way to prevent panic, and the world kept using a number detached from reality. The truth surfaced in 2012, when whistleblowers and journalists exposed the scale of the manipulation. It began with Barclays, which admitted the fraud and handed over internal chat logs. What shocked investigators wasn't the content, it was the tone. These weren't criminal masterminds, but everyday traders joking about bending the global financial system. Soon, UBS, Deutsche Bank, J.P. Morgan, Citigroup, and the Royal Bank of Scotland were implicated. All had distorted the LIBOR, either to boost trading profits or to appear financially stronger during the crisis. It wasn't a few bad actors. It was a system designed to reward dishonesty. Governments launched investigations and imposed billions in fines, but the damage was already done, to markets, to institutions, and to public trust. The total penalties reached around $9 billion, a headline-grabbing number that was still tiny compared to the profits made. For many banks, it was simply the cost of doing business. A few traders were arrested, but they were scapegoats, the visible tips of an invisible system. Executives retired, bonuses resumed, and within months, everything returned to normal. The public barely understood what had happened, and that was part of the genius. When crimes are too complex to explain, accountability fades into abstraction. To understand how such a scandal could even happen, you need to grasp what interest rates represent. Trust. They measure how confident lenders are that they'll be repaid. LIBOR was designed to reflect that trust between banks. But when the world tied nearly all of its finances to that single number, honesty became a fragile foundation. Traders didn't need to hack the system. They were the system. They knew that markets don't move on morality, but on incentives. And the incentive was always profit. The more the world relied on LIBOR, the more profitable its distortion became. The mechanics were almost invisible. LIBOR wasn't calculated from public data, but from a daily survey. Bankers simply wrote in whatever numbers they pleased. When profit-driven institutions are trusted to self-report, you don't get truth. You get choreography. Even during the chaos of 2008, banks kept sending artificially low numbers to project stability. Regulators saw the data, chose to believe it, and the illusion became policy. The markets needed calm, not truth, and in the hierarchy of finance, stability always ranks above honesty. When the scandal finally broke, governments faced a dilemma: expose everything and risk shattering confidence, or contain it quietly. They chose containment. Committees were formed, reports were issued, fines were paid, and a new benchmark was promised, one supposedly based on real transactions. In 2023, LIBOR was officially retired and replaced by SOFR, the secured overnight financing rate, based on actual Treasury transactions. In theory, it's cleaner and more transparent, but in practice, it still relies on the same institutions, the same incentives, and the same culture that allowed LIBOR to exist. The names changed. The behavior didn't. Because the LIBOR scandal was never truly about interest rates. It was about trust. The kind of trust that underpins every loan, every central bank decision, every pension fund. The kind of trust that collapses silently, not with explosions, but with spreadsheets and unchecked data. Finance is often portrayed as cold and mechanical. Algorithms, charts, and numbers. But beneath the surface it runs on human emotion. Greed, fear, reputation, ambition. LIBOR turned those impulses into numbers, and those numbers into power. When a banker submits a false rate, he doesn't just distort a statistic. He alters reality. Mortgage payments rise, credit tightens, national debts deepen. The manipulation wasn't victimless. It was a silent tax extracted from everyone on Earth. And yet, it barely made the news. No dramatic collapses, no clear villains, just fractions of percentages, invisible but devastating. That's the quiet genius of systemic corruption. It hides in plain sight, within routine processes, until wrongdoing becomes normalized. The LIBOR scandal revealed an uncomfortable truth. The global financial system isn't built on precision, but on confidence. When that confidence breaks, the screens still glow, but the foundation cracks. The price of money isn't just a statistic. It's a story about who decides, who profits, and who believes. Because those who control the world's money don't need to break the rules. They just need to write them. And perhaps the most unsettling truth of all, the manipulation never really stopped. It simply evolved, hidden behind new acronyms, new benchmarks, and new systems. The cycle continues. If this story gave you a new perspective, follow our channel, like this video, and share it with someone who still believes the system is fair. History doesn't just tell us what happened. It shows us what's still happening.